Welcome to Business Stories on Business Television Africa. We now take a look at the headlines. International Monetary Fund mission warns of challenging times for the Ghanaian economy. Producer price inflation also increases to 23.3%. And out of Ghana, failure to conclude EPA with EU by October may adversely impact the flour industry in Kenya. The International Monetary Fund has warned that the country is still not out of the woods yet with respect to the current economic challenges. The fund maintains that prices of goods and services would continue to rise in the coming months, while economic growth might suffer as well. It's therefore calling on government to quickly work to address the short-term vulnerabilities.
A mission from the International Monetary Fund, IMF, led by Christina Dayskin, visited Accra during February 12th to 25th to conduct discussions for the 2014 Article 4 consultation. The mission met with Vice President Emisa Arthur, Finance Minister Seth Terkper, Bank of Ghana's Wampa, other senior officials, members of parliament and representatives of the private sector, think tanks and the civil society. At the end of the mission, Ms. Dayskin issued a statement saying that Ghana's economy slowed down on the back of sizable external and fiscal imbalances and energy disruptions in the first half of the year. Based on data for the first 3 quarters of 2013, the mission estimates growth of 5.5%, well below the levels of recent years. On the fiscal side, revenue shortfalls, overruns in the wage bill, and rising interest costs pushed the 2013 deficit to 10.9% of GDP versus a target of 9%. The overrun would have been higher in the absence of significant revenue measures, the elimination of fuel subsidies, large increases in utility prices, and compression of other expenditure. The large fiscal deficit combined with a weaker external environment led to a widening of the current account deficit to 13% of GDP and to further pressure on international reserves. The consequent weakening of the cedi together with the large administered price increases contributed to inflation rising above the end-year target range to 13.5%. She noted in the statement that the weakening growth momentum and inflationary pressures are expected to continue into 2014, calling for urgent measures to address macroeconomic imbalances. In the absence of further measures, the mission seeks the fiscal deficit target of 8.5% of GDP at risk. This, combined with a weak outlook for gold prices, would also keep the current account deficit at high levels. She further adds that the success of the government's ambitious transformation agenda is contingent on restoring macroeconomic stability. While welcoming measures already taken and announced in the budget, the mission stressed that additional fiscal savings are required to address short-term vulnerabilities, contain rising public debt levels, and reduce interest rates. This will be essential to stabilize the economy and support private sector development, growth, and employment creation over the medium term. Structural reforms to ensure lasting expenditure discipline are key to sustainable fiscal consolidation. The mission supported the authorities' plan to regain control over the wage bill, helped by their efforts to strengthen public financial management. It suggested assessing additional options that bring predictability to wage developments and contribute to sustainable fiscal consolidation. On the revenue side, there was agreement on the need to strengthen tax administration focused on increased compliance. The mission also called for a thorough review of the tax regime to phase out exemptions and expand the base. In discussions with the Bank of Ghana, the mission welcomed the tightening of the monetary policy stance to defend the inflation target. With regard to the new foreign exchange regulations, the mission agreed with the Bank of Ghana that these measures alone will not resolve the underlying pressures in the foreign exchange market. It recommended a review of the measures after an appropriate evaluation period to